All right, here we are, Chapter 6, Question 14a. So we have this organization called Empowered Solutions. They have the following balance as of May 31st, 2019, as presented on screen: cash, AR, etc. In the first step, we're asked to prepare a classified balance sheet using those balances, and then following that, we are asked to calculate three various ratios. So for this organization, the first step is to provide your titles on the classified balance sheet. So we've got Empowered Solutions. It's a classified balance sheet as at the period May 31st, 2019. As you start the first section, what you'll want to do is first of all start with your various assets. So we'll start in the order of liquidity, being current assets first. So we have cash, accounts receivable, merchandise inventory for total current assets. We'll then have our property, plant, and equipment items, which in this situation we only have equipment, and we'll get down to our total assets. So in this situation, we have the following data. We have $22,000 for cash, $15,000 for accounts receivable, $12,000 for inventory for a total of $49,000, $73,000 for equipment, no accumulated depreciation at this time or amortization. So our total assets are $122,000. As you move down to the liabilities and equity section, you will order current liabilities in the order that they typically are paid off. So as discussed in a previous chapter, you usually start with accounts payable, your trade payables first, followed by unearned revenue being payments provided from our customer group. And then we've got our bank loan current portion, which represents the portion that's due within the coming 12 months or 1 year from the date of the balance sheet. So this is the amount due within 12 months of May 31st, 2019. We then have the bank loan portion for the long-term component, followed by the equity section. So for this organization, we've got $13,000 for accounts payable, $8,000 for unearned, $10,000 in the current portion of the bank loan for a total current liability of $31,000. Add our long-term liability for a bank loan of $20,000 for a total liabilities of $51,000. Our capital of $71,000 for total liabilities and owner's equity of $122,000, which balances to our total assets. The next part of this question then talks about different formulas. The first item is our working capital. Working capital is defined as our total current assets less our total current liabilities. It's a number, it's not a ratio. So in this situation, we have $49,000 total current assets. We've got $31,000 for total current liabilities. Subtract the difference, we've got a working capital positive of $18,000. There are many situations where your current liabilities could exceed your current assets, making this a negative number, which means you have a negative working capital, otherwise known as a working deficit. The next ratio we were asked to provide is the current ratio, which is described as the total current assets divided by the total current liabilities. In this situation, we've got our total current assets of $49,000 divided by the $31,000, which will give us a ratio of, in this case, 1.58. I will say, typically, banks and lenders look for a current ratio that is closer to 2 or above. Anything above 1 is good, because that means you're in a positive working capital position. But typically, if you're trying to borrow funds, you would want this to be 2.0 or higher. Last component is to calculate the quick ratio. Quick ratio is typically determined as cash plus accounts receivable plus your short-term investments, so these are all portions of your current assets, divided by your total current liabilities. This looks at items that you could transfer to cash relatively quickly, versus you might have items such as inventory that you can't transfer too quickly to cash. So in this situation, we've got $22,000 in cash, we've got $15,000 in AR, we don't have any short-term investments, so we've got total quick assets, I would call them, of $37,000. Divided by the $31,000 in current liabilities, we have a ratio of 1.19. In this situation, typically the current ratio is recommended to be at 1.0 or higher. So you'll notice a slight difference from the current ratio. It is always less than the current ratio, but again, 1.0 or higher is the recommended target for this ratio. I hope this helps.